Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. US Treasury Secretary Scott Bessent tells us there's no evidence of foreign governments dumping US debt. We'll bring you our exclusive interview. President Trump floats a tariff exemption for autos and car parts, but reiterates new levies on pharmaceuticals and semiconductors are coming. Plus, LVMH sales slump on weak consumer demand in China and the United States. The world's biggest luxury group warns it's considering price hikes to offset the impact of tariffs.
In the meantime, a quick check on these markets. It feels like a little bit of a breather. We're not seeing the same volatility to the upside or the downside we traditionally do. Futures pointing lower only by 0.2%. I feel like I'm jinxing it as I speak. A bit into the bond market as well. 10-year down about, we'll call it 2 basis points about. That move in the Treasury market, perhaps weakening that dollar further. We're looking at euro dollar now unchanged on the session, but still at a 113 handle. Cable at 132. The countdown to the opening trade starts right now.
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereign.
The Chinese aren't selling, the VIX has peaked, tax cuts are coming. Scott Bessent, the Treasury Secretary, speaking to AMH, putting a nice gloss on what's going on out there. No chaos, nothing to see here. We can move on. It's all good.
Yes, well, he didn't do anything that increased volatility, which seems to be kind of a theme when we hear from Scott Bessent, that he doesn't play into the volatility in markets. If anything, he's a bit of a soothing character, and that seems to be maybe what happened yesterday. But let's delve into some of the things that he was talking about there. So no evidence, he says, that foreign holders of treasuries are selling them, and the two that spring to mind, of course, are Japan and specifically China, I guess, in this context, given the scale of the tariffs that we have now on China. But it's interesting to think about the motivations for where we go from here, because even if they're not selling yet or now or maybe aren't going to, might they be minded to, or at least they have that at their disposal. On the one hand, why would you damage something that you're exposed to? Why would you sort of shoot yourself in the foot that way? But on the other, as Shuli Ren points out in her piece on China, just a slight bit of selling by the Chinese might lean into the bearishness and the negativity around treasuries, and do the job that China would be looking for.
The range of thoughts and decisions and indications that the Chinese are selling on Wall Street is fascinating. How many times on this show have we heard that there's no indication that that's happening, and then on the other hand, that there's a lot of kind of susceptibility that is. At the same time, he's also saying that the Treasury could increase some of their buybacks as well. So he's actually offering perhaps the soothing tone that a lot of people are waiting for Jay Powell to.
You'd also weaken the yuan as well, which would you would strengthen the yuan because the dollar would weaken if you were to sell treasuries. So that would be maybe something the Chinese don't want to do right now. But to your point about the threat, it exists. And reserve managers are nervous about the dollar. How long? The reason he has to do this is because there is nervousness out there. He is being soothing because the market is worried. He is being soothing because there is concern around what is happening with the American exceptionalism and the dollar's status and all kinds of... this is an amazing situation we find ourselves in, that the Treasury Secretary has to say these kinds of things.
And he says they still have a strong dollar policy, Kriti, which takes us onto the tariff conversation.
Yeah, it's a fascinating one as well because, of course, this is the core of the latest bout of market volatility. There's plenty of domestic things happening as well, where the inflation story doesn't even feel like a narrative anymore. Waller over the last 24 hours also saying that inflationary is, he basically calling it transitory. He didn't use the exact phrase, but saying that it is a temporary phenomenon, even though he's staring down the barrel of these tariffs. And I think the news of the last 24 hours on this front is that, one, there might be some sort of temporary pause when it comes to auto tariffs, but at the same time, a probe into chips and pharma getting kicked off. So I don't know what you make of that.
So the auto story is moving kind of today's markets, i.e. Asian markets have been reacting to that this morning. Be interesting to see how Europe reacts. US futures have focused on that latter story, i.e. ultimately we are going to see maybe something on pharma, something on chips. So it's interesting, the market now, the US markets are looking forward and are a little bit more jittery, but not by much. There's no yippiness out there this morning.
No. I mean, it makes a change, doesn't it? Yeah. We're pretty calm, a little calmer than we've been at least. But it seems as if these tariff headlines, then they give with one hand and then they take away with the other in terms of the mood in markets. Because one you could have interpreted as quite risk on, the other as risk off, and so you have them together and you're pretty calm and nothing is yippy, to use that word. But it is interesting to see how this one plays out. I mean, he is somebody who is demonstrating more flexibility, this is President Trump, as we go along, isn't he? I mean, that is something. And he said yesterday, I'm a flexible person. And he does seem to be flexible when it comes at least to the narrative around autos.
It's just confusing, isn't it?
Yeah.
If you're trying to run a car company at the moment,
yes.
How do you make a
What do you
decision?
do?
Yeah.
How do you make sense of this? What's going to happen tomorrow? I have no idea.
And he says the temporary reprieve might be needed because companies are planning to bring things to the United States.
But does that almost soften the blow when it comes to the worries around chips or pharma, that even if there is an announcement there that, you know, in a couple of months' time or a couple of weeks' time, they could also have a temporary reprieve that you're now seeing with the auto tariffs? Is there a bull case to be made there about how seriously you take tariffs?
Well, it wouldn't
from
take
an
long.
investor standpoint, not from a business leader standpoint?
Right, well, also for consumer pressure. It won't take long for somebody to say that you need cheaper pharmaceuticals coming into the United States. I mean, that will be a conversation that is got to quickly.
We're going to get company results. They're going to start coming. They're going to start telling us things about what is actually happening on the ground in the real world. LVMH out with its numbers. So the revenue line in the fashion and leather section down by 5%. Market was looking for a plus 1%.
You clearly weren't doing your shopping.
I think I am definitely responsible for all of this. But you're seeing a slowdown in China. You're seeing a slowdown in the United States. The US slowed down a little bit more than anticipated. There are clear signs emerging that high-end consumers are getting worried.
Yes.
And you see it in real estate sales. High-end real estate sales in the United States are beginning to slow. People are pulling out of deals. There's a piece of the Journal about that this morning. LVMH is another example of this. LVMH is exposed to China, but it's also heavily exposed to the United States. This is clear evidence of the impact that all of this is going to have. The wealth effect is going to be really interesting to watch.
Yes, and it's interesting the levers that companies, to your point about companies going to be talking to us about how they're dealing with this. What levers will businesses start to pull? Well, some might say they're going to go produce in the United States, not LVMH. I mean, it's not really part of the brand, I suppose, to do that.
They have some production there. So Tiffany's produced there.
They do.
There is production.
But the things that aren't produced there, maybe they're being bought because they're French, or, you know.
Yeah,
so,
absolutely.
You know, so that adds something to the brand, doesn't it? So they're not going to be doing that so much, according to the business, but they are thinking about putting up prices. And so you wonder, with the dollar weakness and maybe putting up a bit of prices, where the pain of this will fall, actually.
It's fascinating that has been this kind of price sensitivity has seeped into the conversation, because last week we talked about it on the low-end consumer. We talked about it with Walmart, for example, talking about this kind of price volatility. Now that we're seeing it on the high end as well, where we haven't seen it yet is kind of that middle ground, and I'm waiting to see that as well. The other piece of this, I'm just going to broaden it out to fabrics and kind of retail broadly, is that even in the fashion space that you see, one of the big concerns was not just China, but the fact that the tariffs are hitting Vietnam, Cambodia, Malaysia. So even the folks that aren't in that kind of high-end spectrum are still getting hit, because the supply chains in the rest of Asia are also getting hit.
Fabrics.
I know. I was thinking fashion, and it didn't quite. There was a buffer, a little brain buffer there.
What else we got coming up on the show? We're going to kick this all around. Jay Foley's going to be joining us very shortly from Rabobank. We'll talk FX with her. John White from Calibrate Partners is going to be joining us as well. Alberto Gallo is going to be joining us to talk credit from Andromeda Capital Management. He's the CIO and founder over there, pro-Europe, very pro-Europe in terms of his outlook right now, Kriti.
Absolutely. Plenty of data as well to keep our eye on in the next hours and I want to say days to come. We'll start with what we're going to get today. 9 a.m. UK time, the ECB bank lending survey is going to be hitting the Bloomberg wires. At 10 a.m. UK time, the Germany ZEW survey as well. So are we still worried about that German kind of data and the weakness there? Probably. The survey will tell us to what extent. Of course, at 1:30 p.m. UK time, a quick check on how New York is doing. The U.S. Empire Manufacturing Survey is going to be hitting as well. We got Canadian CPI. I also think it's important to remind our global audience that we've got Canadian politics in the fray this week as well. There's, I believe, a debate happening in terms of whether or not Mark Carney will be the future leadership of Canada. So keep an eye on that in context of some of the data. But I think the highlight for today is going to be the earnings that are coming out of the banks. We've got commentary from Jamie Dimon, commentary from David Solomon, among others, loan loss provisions, some worries baked in this market, but trading revenue coming in hot.
Yeah, at a record trading revenue over at Goldman Sachs, certainly on the equities side of things, a real bright spot. And that picks up on a theme from JP Morgan and Morgan Stanley that, you know, the first quarter volatility, there is good volatility and bad volatility, appeared to be the line coming out of JP Morgan when they were talking about this, and this fell into the good camp.
Yeah, the trading numbers are amazing.
The equities trading numbers are amazing.
The equities trading numbers are amazing. Okay, so, but that is being offset clearly by deals. Deals aren't happening. There's lots of things that aren't happening right now, so clearly the CEOs of these companies are going to want to shine the spotlight on the very nice trading numbers, but they are good.
Yeah, and Solomon very keen to point out that he is confident that the US administration is working on regulation, and he listed a number of areas that he thinks they're working on regulation, on capital, on leverage, liquidity, supervision. That's a busy to-do list, but yeah, perhaps conversations ongoing there.
All the news coming down the pike that a lot of these banks were super optimistic about going into
January, wasn't
the
it?
election. I have to say, yes, it feels like a lifetime ago, but it's fascinating because here's what we haven't heard from the banks yet. We haven't heard of auto delinquencies. We haven't heard of late mortgage payments. We haven't heard of credit card debt piling up just yet.
But
and
that's not in their space, though.
No, but they are affected by it. Like, it does come up in those numbers.
So JP Morgan did point out they are making bigger provisions. They are starting to highlight the fact that there is risk there.
Yeah.
But you're going to see it first in much greater quantum further down in terms of the credit card companies, some of the lower lenders in terms of the FICO scores that you see. You're not going to see it initially in the banks, but the banks are already starting to make moves in that space. So I think it does feel as if they are at least foreshadowing some sort of a move there.
Well, I think that's why Citigroup is going to be really interesting because they actually do have a decent credit card business as well, and they're exposed to the international consumer, not just the American one, more so than some of their peers.
There's a lot going on. Like, it feels quieter today relative to some of the recent days, but there's lots going on. What else do you need to know this Tuesday morning? Well, Nvidia says it's planning to deliver up to $500 billion worth of AI infrastructure in the United States over the next 4 years. In a statement, CEO Jensen Huang said the American manufacturing partnerships his firm is working on will help Nvidia strengthen its supply chain and boost resiliency. Production of the company's latest generation AI chip, the Blackwell, has already started at TSMC's new plant in Arizona. Staying in tech, Meta's CEO Mark Zuckerberg is facing questions, or has faced questions, about his acquisition of Instagram on the first day of a historic US antitrust trial. During his more than 3 hours of testimony, is that the right word? Zuckerberg revisited a time more than a decade ago when he doubted Facebook would be able to compete in mobile photo sharing, and as a result decided to buy Instagram. The trial could force the tech giant to break off Instagram and WhatsApp, potentially erasing hundreds of billions of dollars of Meta's market value. Zuckerberg is expected to testify again later today. And President Trump's administration has frozen $2.2 billion worth of multi-year grants to Harvard University after the institution refused to agree to a list of government demands. Those demands included reforming governance, ending diversity programs, and changing admissions and hiring practices. Harvard's president, Alan Garber, says the school will not surrender its independence or its constitutional rights, adding the government's demands go beyond combating alleged anti-Semitism.
That's a wrap-up of some of the big stories we're covering then this morning. Coming up on the programme, we'll take a closer look at the stocks to watch at the opening trade, including BE Semiconductor. This after Applied Materials, the largest US producer of chip-making machinery, disclosed a 9% stake in the Dutch company. So we'll certainly focus on things tech for a number of reasons. Plus, we'll bring you more from our exclusive interview with the US Treasury Secretary Scott Bessent. We told you some of the lines. We'll have plenty of clips from that interview throughout the programme. Up next, we'll get into a macro conversation. We'll be joined by Nanette Hechler-Fayd'Herbe, EMEA CIO at Lombard Odier. If you want to get into any of these conversations with us, please get in touch. IB plus BBTV Go. That is the way to get in touch with the team that puts together this programme this Tuesday and every day. This is Bloomberg.
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Here's Treasury Secretary Scott Bessent speaking to AMH, talking about the fact there is a safety net. We've got things we could do. The fact that he has to say that, though, I think is quite significant. Anyway, the Treasury market looks a little calmer. Valerie's here with the details.
Guy, that's right. There is a bit of calm returning to the Treasury market. We had a rally yesterday, the first one in 5 sessions, and it was a double-digit move when it comes to the 10-year yield, a 13 basis point move to the downside for those Treasury yields since the beginning of trade Monday. We're also seeing some normalization when it comes to swap spreads. Those are the things that blew out to historic lows last week. Just another hint that liquidity and calm is returning to the market. Also, those comments from Scott Bessent helping things out when he mentioned he could facilitate liquidity by doing some off-the-run buybacks. Also, to help the Treasury rally was quite dovish comments from Fed Governor Christopher Waller. He, in this speech, if you're a Fed nerd, I urge you to read it, basically argued that in a large tariff scenario, the Fed has maybe an argument to front-load Fed cuts rather than to wait for weak economic data. He also went on to say that in his best judgment, that inflation from tariffs will be temporary. He's kind of an outsider when it comes to the recent Fed speak we've had, but this dovish sentiment from Fed Governor helped the bond market yesterday end on a strong point. I do want to note one thing about his comment about inflation being temporary. We are seeing this reflected in the New York Fed consumer survey on inflation expectations. While we have seen an uptick in near-term inflation expectations, that's this yellow line here, that's the one-year inflation expectations. The longer-term inflation expectations, the 3-year and the 5-year components, remain unchanged. So this is a kind of an argument that inflation from tariffs will be transitory or temporary, whatever T word you want to use there, Guy.
Yeah, Waller definitely saying everything the market wanted to hear yesterday. Valerie, thank you very much indeed. Joining us now, Nanette Hechler-Fayd'Herbe, EMEA CIO at Lombard Odier. Nice to see you, Nanette. Are you feeling calmer about the Treasury market this morning? Is the storm past?
I think we are coming in this stabilization, really, because already last week the auctions went really quite well with also foreign participation, and I refer to the US Treasury auctions, and also the fact that there is calm that is returning to markets with generally sentiment that is improving on equities, where we are also seeing, for example, high-yield credit spreads starting to narrow again. That bodes well for a normalization in the US Treasury market as well.
Can I rely on this normalization to continue? How much volatility do you anticipate?
I think obviously we have to acknowledge that at the moment there's a lot by way of news flow, but I think it's pretty compelling. I've been looking at the US TIPS market, and when I am seeing real yields on 10-year maturities in inflation-protected bonds that are running at 2.3 or where they were percent in real terms, and investors are getting on top of that full compensation of inflation wherever inflation is. And I'm contrasting those real yields to anything else that I'm getting in international bond markets, government bond markets, then this is it's a compelling story. So I believe there is sustainability in this return to calm.
The return to calm has sustainability. That's good to hear. Nanette, thank you very much for joining us. We were hearing there, you were talking there about tips and inflation-protected investments. We were hearing there the views of Christopher Waller saying that inflation is going to be temporary. I mean, mechanically, many people will say, yes, of course, it will take a mechanical step upwards with the imposition of tariffs if they're passed on to consumers. But what understanding do we have about the way that secondary effects of inflation will spread in the US, and how is that influencing your thinking?
Yeah, it's a good point. I would just note the following. The 10-year break-even inflation rate has remained stable throughout, and it was also mentioned in the show how the headline inflation over 1 year is really signaling different things, temporary nature of the inflation increase. I'm very focused on a couple of things in the US. One, energy prices, oil prices, but also gas prices are likely to continue coming down. That's an important part of consumer expenses. Two, housing prices are likely to come down if there is really this focus on facilitating housing permits in the United States. I am going to be completely focused on the new housing sales and permits, new housing starts this week, and I think that investors should continue to focus on that. And finally, deregulation measures are likely also to affect services inflation. So you have to balance these two out. And that is really the uncertainty. Even the Federal Reserve is currently looking towards really getting a better handle on the two counteracting effects here. I would say inflation uncertainty is high, which is why I really like the inflation-protected TIPS market in the US.
OK, so watching TIPS and certainly watching that housing starts data. Nanette, away from the United States, we're going to get an ECB rate decision. I wonder how big a cut the ECB will be minded to make this week.
Consensus is 25 basis points, but I'm also looking at obviously how strong the euro has become. Even if this is transitory, the euro is a headwind for many companies and also for all those economies in the European Union, which are very export driven. I think we ought to be expecting earnings growth to come down of these European companies as a result. And so I'm not completely excluding the fact that the ECB would want to get ahead of the curve. After all, we are expecting that the ECB is on the road to cut interest rates towards 1.5%. Whether they do that in their usual measured way of 25 basis points, which they're known for, is what the market broadly expects. But there could be surprise as well with a 50 basis points. It's rare, but let's see.
Nanette, it's Kriti in London. I want to bring right back to the markets here because as we talk about this kind of volatility we've seen on both sides of the Atlantic, the consensus seems to be that it's actually been a fairly orderly sell-off. No cracks in the system. I would argue, or I guess I have to ask you, is there too much liquidity in the system? Is there a digestibility issue here when coming to the things like issuance that you had discussed earlier?
No, I'm not so sure that we can reflect what we saw, for example, in the swap spread and in the swap market, as opposed to the government bond market, as an area of too much, just too much supply. I think it's pretty orderly. Right now, investors are obviously very uncertain where they put their bets, and so we ought to be expecting these adjustments not to be linear and to still have some back and forth here. But I have to say I have been reassured by the fact that VIX is gradually on its way down, that investors are going to come to their senses and look at things like interest rate differentials, for example, between the US and other countries. In Europe, rates are going to come down. If you take a look at the Swiss franc and Swiss rates, they will probably be at zero by June. And so people are returning to fundamentals, and that's a good thing.
All right, Nanette Hechler-Fayd'Herbe, EMEA CIO over at Lombard ODA, joining us this morning. We thank you so much. It's really interesting that she's making this commentary of kind of that the VIX is going to come down, that this peak uncertainty dynamic is very much baked into the market consensus.
Yes, Scott Bessent would agree, wouldn't he?
Yes.
He says the VIX is going to come down. Yeah.
Nothing to see here. It's all good. Tax cuts are coming. VIX are coming down.
It doesn't seem to be his role, at least, to boost the VIX. We have plenty of commentary
he has others within the administration that are perfectly capable of doing that.
So he has to be the counterbalance to all of it. I think it's fascinating, though, that everyone's kind of believing this is peak uncertainty, even though we are still waiting for auto tariffs, or at least the clarity on auto tariffs, chips tariffs, pharma as well. We're not seeing futures react as much. Are we going to see that change at the open, perhaps?
Is it peak uncertainty? So peak uncertainty maybe, but do we just end up with a period of high uncertainty for a long period of time? And is that just as damaging as maybe all the volatility that we're seeing kind of at the beginning of...
Peak and settle at a higher than usual rate.
Yeah.
But that does more damage to your point earlier, that the companies can't actually make decisions and freeze and brace for impact, and they don't have the capex spending or the buybacks. I feel like the list goes on and on when it comes to the worries. Let's add to that and talk about how it reflects in the FX market as well. Given that the dollar is hitting a 6-month low this week, we're going to dive into the details with Jane Foley. That conversation next. This is Bloomberg.
Welcome back. 30 minutes until the start of the opening trade. Let us have a look at what is happening in the futures picture right now. Things look a little calmer. That said, we could see some movement in the CAC 40, of course, because we had those numbers out of LVMH that were disappointing. And so ADRs in the US went lower on that. We'll be looking for a read across into other luxury names as well. So we could see some negativity around the French market, possibly some positivity around the German market and other areas where you see reference to chip to autos, because sorry, not chips, but to autos today, because we've had the possibility of an olive branch to the auto sector. More on that in the next hour of the programme, but we will certainly watch that sector as we get into trading. And in terms of bond markets, we'll wait for gilts to open, of course, at the top of the hour, because we had some labour market data that didn't move things much, but according to Venram on the Markets Live blog, gilts could move more than sterling, so we'll keep an eye on that. This, for the moment, is the movement we have in European bond markets as Treasuries, Kriti, look a little bit calmer. Let's go to Kriti, who has a chart that has caught her eye this morning. Kriti.
I think that key word, Anna, is calmer, especially when it comes to that bond market, as we know that is the panic that led Donald Trump at least to kind of maybe hit that pause for 90 days. But I think the bond volatility question is one that is going to continue, which is why the chart that's caught my eye has to do with the term premium of the 10-year Treasury, essentially how much risk is associated with holding a 10-year Treasury bond to maturity. And you can see that we are creeping higher. Now, let me walk you through this, because we are now at the highest term premium on that 10-year in over a decade. You have to go all the way back to 2014 to get back to these levels. Now, this is crucial because all of this red on the screen has to do with when you have more of an inflation expectations in the short term. So that's really where that inversion of the curve is showing up in this part. And now we're reversing that trend. But Anna, there is a laundry list of risks here. And this is really important because it's not just about the volatility associated with tariffs as well and the international response from the United States, but the domestic one as well. What does spending from the U.S. government look like in the context of kind of these DOGE reforms, in terms of payrolls, in terms of defense contracts, in terms of that input that we ultimately get U.S. GDP? And the other piece of this is going to be the inflationary shock off of tariffs and how that shows up, not to mention any sort of de-dollarization. All of that is going to show up, and those worries are going to show up in a term premium like this.
OK, let's think about the dollar and the role of the dollar as a reserve currency then. Jane Foley joins us, head of FX strategy at Rabobank. And Jane, good morning.
Good morning.
So much to talk about then when it comes to FX in this context, in the context of the second Trump administration. We've heard from Scott Bessent overnight. He says they still have a strong dollar policy. The dollar, of course, has been weaker through all of this tariff drama. Has something fundamentally changed in the market's view of the dollar as a reserve currency? I was at an event last week and lots of people just said, well, Tina, there isn't an alternative. But does that matter?
It does matter, but it doesn't mean to say that we will carry on this gradual trend away from the dollar. I mean, if you think about, why is the dollar a reserve currency? When over the last, 40, 50 years, the share of world trade from the US has shrunk, really, because obviously China's grown, emerging markets have grown. But the dollar is still, nearly 60% of reserves. And perhaps the correlation, there's a loose correlation between the amount of invoices done in or written in US dollars. So around about 50% of the world's invoices are written in US dollars. So fundamentally, central banks need dollar reserves. And I think that will change. And I think we can actually draw this back to the first Trump presidency, when there was this need. Even the Europeans weren't happy when, for instance, Trump pulled the US out of the Iranian nuclear accord and basically told European companies they had to pull out too, otherwise they may not have access to dollar funding. The Europeans were not happy about that then. So I think there have been changes made since the first administration to make perhaps other currencies a little bit more resilient, and I think that trend will continue. So I think the de-dollarization is a issue. It is a concern. It will continue, but we can't replace the dollar quickly. There isn't a clear alternative.
So you're describing a currency that has that status because of the role it plays in global trade. So if lots of other currencies are doing their bit in global trade, and increasingly so perhaps, and the role of the dollar is dropping a little, do we need one reserve currency, or can we have many?
Now that question is, I think, very difficult to answer now, but perhaps part of the answer is in the perception that we are moving on to maybe more trading blocks. So, for instance, if we look at what the IMF has been saying in the first Trump administration, because of the trade frictions that he then injected, what we saw was not a decline in overall trade, world trade, but we saw it change. So we saw more trading done within blocks. If we carry on moving into that system, yes, maybe you will see different currencies being more important in those separate different blocks. But it's very difficult to answer that question right now.
Let's go around the world. Do you like the pound?
Not as much as the euro.
OK.
You know, I think...
sell the pound against the euro, buy it against the dollar?
Well, one thing I would say about the euro is that it's come an awful long way. And I would say that the standout performer over the first week, say, after the reciprocal tariff announcement, was the performance of the euro. It was standout. It was doing a really good impression of a safe haven currency. And that perhaps has really gone a little bit too far. And so
you're saying it's not a safe haven currency?
Well,
by
you know,
implication.
I would say that it's only 25 years old. Ever since, you know, in the 90s, economists were warning that, well, you know, how can this currency have longevity because you don't have fiscal union? We've had a debt crisis, you know, 15 years ago. So its history is mottled. Yep. But it still has a current account surplus, and I think that is really important. And sentiment in the euro had already become a lot more favourable a month or so ago because of the German debt brake and because we know that they are going to be spending money. So it's already the fundamentals of the euro had changed. Everyone was thinking, well, that's a real sea change, you know, in favour of the euro. It's got a current account surplus. And really what makes, say, the Swiss franc and the Japanese yen safe havens is because they've got current account surpluses. And there is behaviours. We saw this. I mean, I remember very early in my career, the ERM crisis. People tend to go home, bring their money home when there is a crisis. Hence, safe haven currencies become current account surplus currencies become safe havens, such as the yen and such as the Swiss franc. And then speculators learn to follow that trend. And we do have a current account surplus in the eurozone. So the euro, you know, was gathering a lot of momentum over the last week or so, but it has come a long way. The ECB are likely to cut interest rates. They don't want a currency that's too strong.
ECB, the euro just needs to grow up a bit, to be honest.
25, it's not old enough.
I'll let it know. I can't even recover from that. Jane, talk to us about what fair value is for the euro at the moment.
Well, at the moment, I mean, you know, you can look at models and say, well, what is long-term fair value? And it could be 120, 125. But, you know, can we get there that quickly? Well, no, because the Europeans would be very uncomfortable if we suddenly surged towards 120. You know, the US officials would be too. So, you know, an interest rate cut from the ECB, the strength of the euro recently, you know, the two things may be linked, or at least to some degree, it may push some people, you know, towards strengthening their argument for an interest rate cut this week amongst the ECB Council members. But, you know, I think, you know, I was expecting we could get to, you know, maybe 115 in a year's time after the Germans changed their debt rate. We've got there almost, you know, very quickly. So I think we do need a little bit of consolidation. Perhaps we do need a little bit of, you know, pulling back from that. And then we have to see where it goes in terms of, you know, German economic growth. And it is notable that most of the big forecasters who've upped their German GDP forecast on the back of the fiscal reforms, it doesn't hit the growth forecast till 2026 and beyond. Not this year. We're still going to have stagnation this year. So I don't think the Europeans would be too happy if the euro went too far.
Can I just point out the pound first appeared in 1489? Doesn't feel like a safe haven.
I was going to say, did do all the growing up it needed to do. Well, coming back to the concept of safe havens, you were talking about the Swiss franc and the Japanese yen. There's a question right now, or a concern right now, that the Swiss currency may get some sort of currency intervention. Should we be thinking about that?
Well, you know, they continue to maintain currency intervention as a policy tool. You know, we know that. But at the same time, they don't want to be pulled out by the US Treasury as a currency manipulator. So that is a concern. So maybe they'll, you know, sit on their hands for now, wait to see if there is a response to that from the US Treasury. But it is a risk. I mean, you know, if you look at the inflation in Switzerland, it's pretty low. You know, and their interest rates, of course, have been cut down to pretty low levels too. So the market, you know, a month or two ago was thinking that's it. You know, Switzerland's done. They won't have to cut interest rates again. And now they have this sort of problematic rally in the Swiss franc, which will just depress inflation probably too much. So it's a risk, but it's something that maybe they're going to feel very uncomfortable about now.
Continuing our trip around the world, if we go to China, there's been a lot of talk about whether the Chinese and the Japanese might be tempted to sell some of their treasury holdings, given the tensions that exist right now. But then, as Guy was pointing out at the top of the hour, that might do things to China's currency that it doesn't want to see right now. What do we need to know about the way they're managing the yuan that tells us anything about what they're likely to do on treasuries?
Well, it might do things to the currency that they don't want to do, but also, you know, they hold an awful lot of treasuries. If they allow the value to go down, well, they're going to take a massive, great big hit in terms of the valuations of the holdings that they own. Politically, it might be a step too far right now. you know, that would be a very difficult issue. In fact, we've had indications from the Japanese that that is not something that is going to come up in this week's trade negotiations. You know, the fact that they have this massive holding of US Treasuries. What is more likely to come up, certainly from Japan, is the foreign direct investment. Now, that had been pledged to increase in February when the Japanese were in Washington. They pledged to increase that hugely. They were already the biggest provider to the US of FDI. You know, they thought by promising, you know, a couple of extra investments from some of the big Japanese car manufacturers into the US, for instance, that they would be let off lightly in terms of tariffs. Not so. They were surprised, I think, when the US administration wouldn't allow them off the steel and aluminium tariffs. They certainly want some resolution with the auto tariffs. So the FDI, I think, is more likely to be a negotiation tactic, probably not the Treasury holdings, because that is so politically sensitive.
Very quickly, do you trade that? Do you trade changes in the FDI between Japan and the United States?
I think what we can say is that Japan has a pretty strong hand relative to many other nations in going into these trade talks, because they do provide so much. And also, you know, think of things like shipbuilding. So Trump wants shipbuilding to go back to the US. That could take 15 years. It could take longer. Meanwhile, you know, you've seen American military contractor sign an agreement with a South Korean shipbuilder last week. The US needs Japanese and South Korean shipbuilders. Simple. You know, Japan does have a pretty strong hand. So, but at the same time, it's one of those countries that probably wouldn't mind a little bit of yen strength as well. So I think the yen can remain firm this year.
Lots to digest. Jane Foley, always a pleasure to have you on, the head of FX strategy over at Rabobank, joining us around the table. We're going to stick to that conversation of trade and what that looks like, except this time with a focus on European auto stocks as President Trump floats a potential temporary tariff reprieve on the sector. More on today's Stock to Watch next. This is Bloomberg.
40 minutes, the equity market open. Let's carry on digesting and segmenting what we got yesterday from the US Treasury Secretary. Scott Bessent rejecting speculation that foreign nations are dumping US Treasury holdings. He also downplayed concern about the dollar status as a global reserve currency. He spoke exclusively to AMH. Bloomberg's Anne-Marie Hordern.
We are still a global reserve currency, that we have a strong dollar policy. The dollar can go up and down. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, I can't remember, 7, 8, 9%, and then once the tax bill was done, took off for the remainder of his term.
Have you spoken to the Fed at all about contingency plans, though, if financial stability risks flare up?
Chair Powell and I have breakfast every week, and we discuss a wide range of things. And you know, our staffs are always in contact. We have a markets room; they have a markets room. But you know, and specifically, did we discuss some kind of a break the glass? I think we're a long way from that.
So when was the last time you guys spoke? You had breakfast last week?
We had breakfast last week, and it was an away game. I was over at the Fed.
And no concern so far from the Fed chair on what he saw in the Treasury market?
I think we would have heard from the Fed chair. I think we heard from Governor Collins of Boston on Friday. We heard from Governor Weller today on his thoughts on what tariffs mean. So it seems like business as usual. When
it comes to the Fed chair, his term is up May 2026. So we're almost 12 months out from that. When are you going to start to think about and have these discussions with the president about who should lead the Fed? Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall. In the fall, so about 6 months lead time. Yep. The U.S. Supreme Court recently came out with a ruling that the executive branch, the president for now, could oust top officials at independent agencies. And that has some individuals in the market a little bit concerned about what this could mean for the independence of the Fed, which is really a cherished pillar of wanting to invest in America. Do you have any concern about potentially President Trump ousting Fed Chair Jay Powell or the independence of the Fed? Well, and Marie, I've
repeatedly said the Fed has two duties, and I believe that monetary policy is a jewel box that's got to be preserved, and then they have regulatory policies, and I think we can have more of a discussion because the Fed is one among three bank regulators, and there's the Fed, controller of the currency, and the FDIC. So I think it's very easy to delineate between those two.
So at the moment, no concern?
No concern.
When you talk to Fed Chair Jay Powell, at the moment it doesn't sound like they feel like the need to step in on this unraveling we saw last week with the bond market. Does the Treasury have any plans to do something if this was to become more unnerving?
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that.
But all options would be on the table?
Sure. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Scott Bessent, US Treasury Secretary, speaking there to Bloomberg's Anne-Marie Hordern. So where does that leave markets? Let's get to a conversation, 3 minutes on the markets, with our Markets Live Executive Editor, Mark Cudmore. Mark, good morning to you. So we're 10 minutes from the open here in Europe. Things look a little calmer. The futures picture looks a little calmer, certainly in the US. We could see some volatility, but actually around earnings, a bit of tariff news here in Europe. But US futures do look a little calmer than they have looked. Is this calmness or is this just exhaustion?
It is just exhaustion. It's always tough when you kind of oversimplify the market, but basically there are people that have just lost too much money and they're feeling broken. It's not the time where they've got the appetite to be greedy or want to be a hero. And then there are those who've got this roughly right, and they know that, hey, they've got ammo in their pocket, and this is a market that will continue to provide a lot of volatility in the months ahead. So wait to the next trigger, wait to the next opportunity. Right now, with a shortened week around the holidays, the fact that we're waiting for kind of the next steps on tariffs means there's no reason to rush back into the market. The underlying trends that we've been talking about since January remain very clear. They look quite extended in the short term, so it's very awkward. You've got a short-term time span where you're like, hey, the really logical fundamental trades that are going to work for the next couple of years, they're overextended in the short term. So do you wait for the pullback or do you chase them aggressively now? I think most people are saying, I'm exhausted, I'm tired, let's go through Easter, or the next big trigger, next big news headline, and not chase.
Where does the dollar fit into that, Mark?
As you know, Guy, I think dollar is started a long-term depreciation trend in January, and I think that continues to be the case. But the dollar is the one that's probably been most persistent. I think it stays soft into the Bessent meeting with Japanese officials, because there is that speculation. I think your previous guest, Jane Foley, outlined that any Japan deal, and they'll be likely to make a trade deal, would involve a slightly stronger yen. While that's very logical, and I actually kind of agree in that theory, I think there's going to be disappointment those who are speculating some short-term announcement on anything meaningful in the yen. They might allow the yen to appreciate, but they're not going to do some big grand deal. So I think that what we could see is dollar stay roughly soft until then, and then it maybe bounces after then, kind of wears off some of the oversoldness. But overall, this is a market where the dollar is in a long-term downtrend, but it's just overextended in the short term.
Mark, does the dollar follow the moves of the Treasury market?
Look, I think that the Treasury market is a super interesting component here, and I expect that we'll see Treasuries come back under pressure again. I do believe that Bessent could not say anything else, but I don't think that his comments are particularly game-changing. We've got a whole world that is very exposed to US Treasuries and worried about the policies of this administration, worried about what they might do next, and ultimately people want to lower their exposure to those Treasury markets. If you add in the fact that it's expected that we'll see some aggressive tax cuts and an increase in the fiscal stress in the months ahead, I expect long-end Treasuries to sell off again this year, perhaps significantly at some point. But short term, I'm not particularly worried. I think it is calm for the moment. The market is functioning. It's a longer-term story.
All right, Bloomberg Markets Live Executive Editor Mark Cudmore joining the program this morning. You can get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So LVMH shares set to fall at the open of trading in Paris after a really weak report from the luxury company last night. Here's what the US ADR did in late trading. We can see it dropping around 9%, coming back up a bit, down around 6% on the day in the regular session there in the US. And we're set to see a feed through into peers, given the magnitude of the drop down in the leather goods business. Sales on an organic basis in the quarter down 5%. The market only expected a 1% drop in sales, so really missing expectations. We're likely to see the peers like Burberry, Kering, also potentially Hermès dropping. Hermès has results later this week. And then the drinks as well. Drink sales in wines and spirits down 9% on the quarter at LVMH. That includes Moet and Hennessy, so we're likely to see weakness in Remy and Pernod Campari, Diageo, all the usual suspects on that screen. And then finally, in the cosmetics business, we saw a drop down in L'Oreal's US shares as well when the report hit, because that was another weak part of the report. So pretty much every unit at LVMH missing expectations by a considerable amount. And we're set to see significant drops in that sector today. Then another sector that might do a little bit better is autos. This is after Trump indicated that there might be a bit of a reprieve on the tariffs for the sector, though he hasn't kind of explained what that might look like. But we did see a jump up in Stellantis in US trading. Remember, that's listed in Italy as well, so that one should be higher. And then keep an eye on the other peers, Mercedes, BMW, and the parts as well, like Valeo and also Michelin. Potentially we're going to see a boost on that. And then a really interesting deal in the semiconductor space, Applied Materials buying 9% of BE Semi. That is a big deal. They do have a partnership already. Keep an eye on that one over in Amsterdam.
OK, we will watch the tech space then, Joe. We might see autos going higher, luxury coming down. We'll also keep an eye on Ericsson. We have numbers out from the telecom equipment maker, so we'll keep an eye on that one at the start of trade. 7:54 here in London. We will be back with the market open. Futures actually quite varied based on your exposure to cars and luxury. We'll be back with that opening trade shortly. This is Bloomberg.
Tuesday morning, good morning. Short weeks always feel longer, don't they? I think the market just wants to get to Thursday, get this week done and dusted, move on, see what happens next. Europe went out at the lows of the US session yesterday, so we've got a little bit to climb back into today in terms of the performance coming through. But there's lots of other factors at play here. What is happening with the pharma space? What's happening with the auto space? What's happening with the chip space? Lots of unknowns around key areas for this market right now. Plus also, we need to factor in LVMH's numbers yesterday, the sales and revenue figures, Kriti. That's likely to impact France pretty heavily.
Impact France, and already getting kind of priced into the futures picture. You're seeing it pretty aggressively here. The CAC 40 down a whopping 0.7%, a real reversal from what you're seeing in the FTSE 100, and arguably in the rest of Europe as well, because analysts do still have to digest the auto sector impact as well. That's going to offset perhaps some of the pain you're seeing in France with some positivity you're seeing in Germany.
Yeah, absolutely. Could we see some in the auto space go higher? The futures for Germany suggest we could see that a little bit, Kriti, so we'll keep an eye on the auto sector, of course. President Trump floating the idea of some kind of temporary reprieve for that sector. The luxury space, as you mentioned, yes, that will weigh on France. The US and China, both of those markets called into question by what we heard from LVMH. The ADR's down heavily in session or in the United States yesterday, and so we'll watch to see what that does here in Europe, both to their share price but also to others. Hermès, for example, we're set to hear from Hermès a little bit later on this earnings season. Ericsson also could be in focus this morning. The telecom equipment company profits from networks adjusted operating margin, more than 20%, and that seems to be higher than the market had anticipated. So this could be one that goes higher. With all that said, though, I mean, we could have put all things on this list, Guy. Pharma, chips, everything. We'll watch how it all responds to the latest news flow.
Absolutely, and when does that news flow come? Right, time for the market open, time for the opening trade. Europe used to be all about luxury stocks. Now it feels like it's all about defence stocks. We're going to compare and contrast maybe the CAC 40 and the DAX today. Look at what Rheinmetall's doing. CAC, we'll wait for that to open. We'll wait for the DAX to open. We've got the FTSE 100 out of the gate early, as always. It is up by 0.1%. The Stock 600 is up by 0.2%. How quickly will we get the bid offer close to open? LVMH today. What happens with Hermès? Remember, it's got numbers out on Thursday. L'Oreal's got numbers out on Thursday. Got Moncler out this week. There's a lot going on in that space as well. The IBEX is out. It's up by 0.4%. So a cautious start, I would argue, this Tuesday morning. Can we call that calm? I don't know. Kriti, what's going on below the surface?
We're seeing a little bit of a mixed picture when it comes to below the surface. Right out of the gates, we're seeing the likes of ASML really lead this market higher when it comes to this index contribution. In the FTSE 100, a similar story as well, where some of your traditionally defensive stocks are leading this rally. Healthcare is, however, on the back foot. I am seeing several of these names take a little bit of a beating, from the likes of Roche, for example, to the likes of Sanofi. And even the French stocks also, it feels like, taking a little bit of their messaging from the numbers we got from LVMH as well. So, Anna, almost a little bit of the expected, but also a little bit of a mixed bag.
We do see some of the sector breakouts that we'd expected. So technology, that's an area of focus. Autos and parts is the one I wanted to mention, up by 1.8% this morning. We've got the likes of Valeo going higher, Stellantis going higher. That's up by 4.6%. So we did see some of the automakers over in the United States going higher on the back of Trump's latest comments, suggesting perhaps some kind of reprieve around some of the tariff situation for autos. And, of course, Stellantis has a substantial presence in the United States, so it makes sense that that one is more volatile in the face of that kind of news. Consumer products and services, then, is the weakest sector, and that speaks to the luxury news. We've got Kering there, Christian Dior, Moncler, Hermès, L'Oreal, Bruno Cucinelli, Burberry. They are all down by more than 2%. Richemont not far behind. So we're certainly seeing some weakness coming through on that particular sector.
I think UBS is XD today, isn't it?
Yes.
That's probably one of the reasons why. Yeah. So UBS is XD. Yeah, you've still got L'Oreal and Hermès are the two biggest points drops in the luxury space this morning, right now at the top of my board. Both of these companies still have to report numbers. How much of a predictor is LVMH in terms of what we're going to see with some of these other names? Does Hermès still have pricing power in the way that LVMH doesn't?
Yeah.
The further up you go up the income scale, do you get less volatility maybe around some of the earnings? I keep coming back to it. The Birkin handbags of Evelyn Good. It's almost price irrelevant. The long list times, the long lead times in terms of production, huge lists in terms of getting hold of these things. Does that protect that company? How much titration difference are we going to see in that space?
Absolutely. And we should mention that LVMH is actually still halted. So all the indications that we're getting from some of these other kind of players in the luxury space of something like 3-4% declines, perhaps early indications of some of the pain we might see in the likes of LVMH. All right, so what do you do when you don't know what to do? We got to ask John White, founder of European long-short hedge fund Calibrate Partners, joining us around the table. And John, as we literally come to you, I'm seeing the DAX open higher by 0.6%. The French index is not open just yet. But again, it comes down to this idea of we keep going back and forth. What do you do when you don't know what to do?
You guys always ask great questions.
What are you doing?
Well, I think, when you're a bit unsure, I think your starting point is you probably do a bit less. But whenever I've seen, in my experience, seen markets go through these types of shocks, they generally land in a place where investors are happier to own stocks and companies where you have more certainty over the earnings visibility 1 year, 2 years out. So there are plenty of companies across Europe where we've got, good visibility of earnings, less volatility of earnings, 1 year, 2 year out. So through the summer, I suspect that a lot of these stocks will grind higher as the market gives them a higher multiple. And I think the reverse is true, where we have companies with less visibility. The PEs will contract. So I think that's probably the theme through the summer. And that's certainly how we're playing it.
All right, so that the PEs will contract. But I'm curious if there's hesitation, at least you're seeing early hesitation in terms of things like CapEx spending. We had a guest on yesterday talking about the suspension of buybacks as kind of the big tell for more downside in this market. What's the tell for you?
Well, I think we sort of, if I think about the big building blocks of what we're seeing at the moment, and obviously Trump and tariffs are front and centre, but it might not be the right thing to be focusing on through the summer, because it's clear that there's a feedback loop in process. I mean, for example, we've seen the rollback on car tariffs overnight, and I'm sure that's linked to the fact that VW, for example, has 2 months of supply, US supply, just docked at various ports around the US, and that just creates all sorts of unintended consequences. So the feedback loop, I think, works. I'm slightly more interested in China's reaction to lots of these policies, because that's more difficult to read. And then when you think about Europe, I mean, Europe could be the relative winner in all of this, because it's clear that Europe has been forced into a set of behaviours that we probably wouldn't have scripted a year ago. I mean, the German fiscal change was something that, you know, I think the size and magnitude of that, the defence spend that we've seen, is something that is a bit shock and awe. And I suspect the big call for the next, you know, 6 months in Europe is going to be a Eurobond, and I think that will be linked to you know, to, you know, banking regulation. I think it will be linked to banking consolidation, and I think that will be the key.
Okay, so long banks, defence stocks presumably on the back of that. If you're looking for a sector that's got visibility, I'm presuming defence has it right now.
Yeah. Yes.
At the other end, what doesn't have visibility? Is it the auto sector? Is it the chip space? So you've got two buckets. You've got the visibility, no visibility.
Yes.
And kind of what goes into both buckets?
Well, I think you could probably put LVMH in one of those buckets.
Which one is it?
As we've seen overnight. Yeah. And I think, you know, when you look at LVMH, I mean, it's an incredible brand, and it's an incredible group of brands, and it's an incredible business, and it's incredibly well run, and it's incredibly global in scale. So, you know, whenever you've got a trade war, the likes of which we have, it's clearly going to be difficult to run that business through this type of environment. And remember, you know, COVID wasn't that long ago, so these companies were over-earning for a long period of time, and I think people forget that. So, you know, we've come off the back of these huge retained earnings or retained cash flows that consumers had through COVID, particularly in the US, which is the biggest market for LVMH. And now things are normalising, and you've got a trade war, and it's difficult to manage any business, but to manage, you know, a business that is really, you know, buying goods and services from China and selling them to the US. I mean, that's a pretty difficult, place to be.
Yeah. And John, so all that we talked about has been kind of sectoral, I suppose, rather than geographic. Is it worth thinking about US stocks, or is that not the way you think about it? The reason I ask is we've had a Bank of America investor survey that shows a record number of investors intend to cut US stock holdings. I mean, I don't know if that's too late or if that's well-timed or whatever, but obviously we've seen a lot of pain in some places there.
Well, I mean, we talked about this when I was last here. You know, US retail own more of the US market. I think it's about 38% now, depending on how you measure it, than they ever have done. And, you know, that's not a great starting point. Valuations are still on the rich side. I suspect that buybacks will be pared back in a period of uncertainty. So, you know, the US doesn't feel like the winner in all of this, because, you know, if you join the dots, it's in principle it makes a lot of sense to try and repatriate, you know, more production and manufacturing to the US. But you can't build a factory overnight. There isn't enough power. You know, we've had this whole...
Yeah, it takes a lot, and that's why you're getting the flexibility in terms of what Trump's talking about at the moment.
Exactly.
The problem with all this uncertainty is that companies are just basically withdrawing guidance.
Yes, they are.
How do you... You're looking at your risk positions. You're probably tightening up. You're kind of being a bit more cautious as the market's swinging around all over the place. Introduce a lack of guidance into that kind of scenario for me. How does that change the way that you're going to approach what you do? Because if companies aren't telling you what they are expecting, how easy is it to value them? How easy is it to get the kind of visibility that you're looking for, either on the short side or the long side?
Well, I mean, the market gets there pretty quickly. You know, when companies communicate with us and the market more broadly, they're pretty quick to withdraw guidance, and you don't see it happen very often. I mean, they might lower guidance or widen a range. Which comes back to what we were talking earlier about. You know, the volatility of earnings really matters now. So there are a whole host of companies we can look at across Europe where we've got good visibility, they've got good order books a year out, 2 years out. And again, you know, I sort of come back to European banks because I've got valuation support. I've got good visibility of earnings. I don't think there's going to be a credit cycle in Europe.
Is it easier to do the long side than the short side at the moment?
No, because in a market-neutral context, you think about everything relative to the index.
Yep.
So we're trying to buy stocks we think are going to outperform the index in the medium term, and we're trying to be short of stocks we think are going to underperform the index in the medium term. And I think, you know, lots of investors make this mistake of trying to think of being short of companies that are going to go to zero.
Yeah.
Because there are so few of them. I mean, OK, you know...
It's just an underperformance.
Yeah, I mean, look, very rarely... you know, if you look back at, you know, the last 15, 20 years, there are very few companies that go to zero. Now, there was three famous hedge funds, and it was myself, Lansdowne and Crispin Odey, that were very short of Northern Rock when Northern Rock went bust. But those things happen very rarely.
Yeah.
You know, and Wirecard is another example. It happens very rarely, but it has a lot of impact on your muscle memory. I mean, I think someone was saying to me, if you bought Wirecard on the IPO and sold it 9 months before it failed, you made 10,000%. So being short of these stocks sounds great, but it can be... I mean, for example, I was short of Northern Rock from £5 to £11 on the way up, but we never talk about that.
No.
So managing risk, trading and portfolio construction, correlations, sector exposure and consensus positioning on the short side of a portfolio is much more difficult than people realise.
I'm sure. Yeah. John, thank you very much indeed. Lovely to see you. Thank you very much indeed for stopping by to see us. John White, founder of Calibrate Partners. Let's take a quick look at the centre of gravity here in Europe this morning. This is what we are looking at. You've got Ferrari, ASML tracking higher, but the real story on that board this morning, as we were just mentioning, is LVMH. The stock in Europe down by 7.8%. Let's get more details as to what is happening with the luxury space. Joe's here with that.
So a real widespread move in the luxury space today, Guy, really hitting a swathe of sectors within the luxury goods market. Now, Goldman Sachs calling for LVMH sales to drop 5% on the year now. Previously, before this report, they said the sales would be up 2%, so a massive drop down, and we're seeing a feed through in LVMH, Burberry, Kering, Hermès, all of those stocks feeding through after the LVMH numbers there. Then in terms of the drinks, also weak as well. Now, remember, drink sales at LVMH down 9% in the last quarter, and we can see that feeding through here into the French names Remy, Pernod, also Campari in Italy, a little bit lower, and Diageo here in London as well. Then on cosmetics, L'Oreal coming down over in Paris. Again, weakness on the cosmetics and skincare business in LVMH, and also hitting Puig brands over in Spain, the Charlotte Tilbury maker. That one hit as well, seeing losses almost 3% there. And then finally, we'll do a fourth board on the LVMH read across, because the watches and jewellery makers also hit. Richemont coming down, Swatch also, and Watches of Switzerland, the Rolex dealer listed in London, all of those coming down pretty significantly following that report. So really the big feed through of the morning coming from that LVMH report. Then going the other way, a bit more green over in autos. We're seeing Stellantis pretty much mirroring that gain that we saw in the US stock. Trump indicating potentially some reprieve, some respite on the auto tariffs, so that is feeding through into that sector today. The German companies also coming up as well, Mercedes, BMW and parts, Michelin, a little bit higher over in Paris as well. Then on terms of the telecoms, we've got Ericsson, pretty good numbers out of that one, and they are up 7% over in Stockholm. The company actually finally seeing a bit of a better outlook in their supply of 5G equipment, so that is boosting Ericsson today. And I think Nokia was ticking a little bit higher as well, so doing well on that. Positive report from Ericsson this morning. And then finally on BE Semi, Applied Materials taking a 9% stake, and the market liking that a lot. That is one of the biggest chip machinery companies in Europe, and they've already got a partnership, the two firms, so that is more positivity for that one. Bit more positivity on semis. That one gaining 8% or almost 9% over in Amsterdam, making up for a bit of the weakness in luxury goods this morning.
Joe, thank you very much. Joe Easton from our equities team. Coming up, we will go back to one of the stories Joe was talking about there. LVMH leads Europe's luxury stocks into the red after disappointing sales results. We will take a deep dive into the sector next. This is Bloomberg.
Welcome back. We are 18 18.5 minutes into the trading session. European equities are broadly higher. The CAC 40 is lower. We can blame the luxury space for that. In terms of the bond market, generally a bid coming through, except in US Treasuries, where actually the market's on offer this morning. But let's come back to what we're talking about with equities and figure out what is happening with both cars and luxury. Going to start with the luxury side of the equation right now. Andrea Felsted joining us now. She's here to talk about LVMH. You cover luxury for Bloomberg Opinion. What's the opinion of these results? What do we learn from these numbers from LVMH?
We didn't learn very much, actually. The big swing, the reason they underperformed worse than expected, was because this time last year, lots of Chinese were travelling to Japan to buy luxury goods to take advantage of the weak yen. That's still going on, but not as spectacular as it was a year ago. In the US, which everyone wanted to know about, demand for fashion and leather goods and watches and jewellery is holding up, which is encouraging. Now, where they could be seeing some tariff impact, but it is a could, is Sephora, the beauty retailer, which appeals to the more aspirational shopper. But again, that had very strong performance a year ago. Now, the one that probably is seeing some impact is wines and spirits, because again, that appeals to a much broader customer base, i.e. think the less wealthy. So far it hasn't shown up in handbags, but it might have shown up a bit in makeup, and it probably has definitely shown up a bit in drinks.
That's interesting, isn't it? Because you think of Sephora and you think slightly, lower priced compared to the other things that LVMH says, and in times when they're tough, you think maybe people go to buy the slightly cheaper end of the spectrum. But anyway, what about pricing then, Andrea? What did we learn about pricing? There was this line about possibly putting up some prices as a result of tariffs.
Exactly. I mean, they will have to pass on some impact from tariffs. They've got away lightly compared with the mass market and the apparel makers. It would have been much easier to put up prices 5 years ago, because all the luxury brands, including LVMH, have pushed up prices a lot over the last 5 years. One of the issues they're facing is this luxury fatigue, where, there's big greedflation in luxury goods and consumers are noticing it. That makes it much harder to put up prices this time round.
Where would they put up prices, though? If we get to that point where inflation is a bigger deal and we need to have some of that kind of margin pressure eliminated, where would be the first goods that see that?
I would think it would be fashion and leather goods. They are the ones that are, theoretically most in demand. They were talking about not really putting prices up, but getting consumers to elevate through the range, so i.e. getting them to buy more expensive products. And that's probably a bit tricky, because a more pressured consumer wants cheaper goods. It's one of the reasons why we have lots of brands that are slightly cheaper at the moment. Coach, for example, is flying because its bags are still pretty nice. They compare well with the European brands, but they're much, much cheaper.
So is that not good news for Hermès when it reports numbers Thursday?
Hermès will be a completely different
story. I did wonder about that. What about Sephora and L'Oreal, though? Is there a read across there?
I think that there is definitely a read across. Yeah, I mean, the other thing to remember with cosmetics is it's been an absolute boom for the last 5 years. It's been lipstick, it's been skin. Hair's been a massive category of growth. How many, lipsticks, how many fancy hairstyling products do you really
You're looking
need?
at the wrong person here.
When times are tough,
Guy needs many.
You just think, well, I won't spend £20 on that. Heat protector, I'll spend, 5. So, there's been this cyclical boom that is probably due for a correction.
I think heat protectors, I think boilers, I think like that. It's a completely different ballgame.
Guy's life must be very nice not to need a heat protector. I definitely need it. Andrea Felsted from Bloomberg Opinion, we thank you so much. Let's continue on where maybe some of the other pain that we're seeing this morning may show up or not show up. European automakers in the green this morning after President Donald Trump said he was exploring possible temporary exemptions to his tariffs on imported vehicles and parts.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
For more, let's bring in Craig Trudell, who heads up our Bloomberg's global automotive coverage. Craig, should we be happy about this temporary reprieve?
Everything's all good now, right? Yeah.
Is it?
I think the answer to that is no. I think, how exactly is this going to work? How short is short term are we talking here? it's going to take these companies and their supply chain, at least a year, maybe 2 years, maybe 3 years to do the level of reshoring or onshoring into the U.S. that Trump, I assume, would want here. Is he going to be willing to cut, sort of that long a slack for this industry? He's a fairly impatient individual, and also, I think in terms of what is actually happening on the ground, I'm not sure we can necessarily take him at his word that the companies are ready to do this, given the way that he's talked about, what some of these companies have been up to, and how much what he says it doesn't necessarily measure up with what they're actually doing.
What's happening in the U.S. car sector at the moment? What's going on? Is anything going on? What are these guys doing? How quickly can they turn things around? Where is inventory building up? Where is there shortage? Just give us a quick kind of thumbnail of the effect that we are seeing thus far to make Trump react like this.
I think we are seeing, the shares of these companies being hit, much as we're seeing this, relief rally just yesterday on the slightest, sort of nod to the idea that, maybe they'll get some short-term relief. They are getting hurt. I think perversely we are seeing a lot of buyer activity, a lot of people going to showrooms to try and get a vehicle before prices go up, because we haven't necessarily seen an immediate move here. We are seeing, some car makers actually, holding vehicles at ports until the tariff, situation clears. We will see prices go up of imported cars, but we do have the situation where we're still a couple weeks out from the parts, tariffs hitting. And so we're not necessarily feeling the full brunt of what Trump has talked about to this point.
That's interesting. And to your point about what the companies are saying they're doing, how much reshoring are they really talking about doing here?
They're being pretty mums of word. I think they are, what we've been hearing out of Detroit is that they've been trying to kind of put emphasis on, let's go easier on the North American supply chain, at least that's closer to the U.S. For a long time, these were our allies. And we understand, the low-cost imports from outside of the region. But, let's at least consider the sort of strategic value of part supply being close to us, at least on the continent. I don't think from that answer that we just heard from the president that he's actually viewing Canadian and Mexican parts content as a positive. He wants it all for the U.S.
Yes, it seems like the business leaders are maybe thinking about supply chain risks, whereas President Trump is thinking about something more political. Thank you very much for bringing us that. Craig Trudell, of course, who leads Bloomberg's global automotive coverage. And so those few words from President Trump: Stellantis up 3.9%, Valeo up 3.6%, and the addiction to lines coming out of the White House continues. Coming up, Treasury Secretary Scott Bessent rejects speculation other nations have been dumping U.S. bonds. We hear from the CIO of Andromeda Capital Management on the ongoing volatility amid the trade war. Things a little bit calmer today, perhaps. Feels dangerous to even say that. U.S. futures pointing a little higher now. This is Bloomberg. Welcome back. This is the opening trade, 30 minutes into this morning's session, and this is the picture that we have now for European equity markets, up by more than 1% on the DAX, and that seems to be leading the way. So the autos lines, even though they were few and far between from President Trump, they certainly have reignited interest in that sector this morning, and we see some of those names go higher, as we discussed with Craig Trudell in the last part of the programme. That's the upside. The downside is the CAC 40. There we are down by 0.4%. LVMH is the big driver, disappointment on the US and China, and that weighs on the wider sector. Now, a record number of global investors are planning to cut their holdings, though, of US stocks. That is according to Bank of America's latest global fund manager survey. Let's bring in Bloomberg's Valerie Teitel, who has more on this, Val.
Anna, this survey really pointing to the fact that investors are shying away from U.S. assets. As you mentioned, there was a record number of investors saying they intend to cut their U.S. equity holdings, and this comes alongside an already largest ever 2-month drop in U.S. equity allocation since the beginning of the survey. You pair this with the fact that they also saw around 80% of respondents saying that U.S. exceptionalism has peaked and they're looking to take their investments elsewhere. Plus, plus a 30-year high. 82% expect the global economy to weaken in the year ahead. Now, I want to contrast this quite bearish report with what's going on in the market at the moment. Yes, the S&P is down on the year, but we are only less than 3% down from Trump's tariff announcement on April 2nd. Doesn't necessarily paint such a grim picture as that fund manager survey. And also take a look at what's going on in credit spreads, Anna. We have seen quite a collapse, quite a narrowing of credit spreads since they blew out last week on both sides of the Atlantic. Credit spreads here in Europe, credit spreads also in the U.S. And we've also seen a return to market functioning. We've seen a return of high-yield issuers coming back to the market. This is not necessarily painting such a grim picture on the economic outlook as perhaps that was reflected in that fund manager survey.
Great stuff, Valerie. Thank you very much indeed. Let's carry on talking about what's happening in the credit space. Alberto Gallo, CIO and co-founder of Andromeda Capital Management, joining us around the table. Credit's tightening up again. Market's beginning to function again. We're seeing issuance again. Panic over? Like, what do you? How do you see what you see in front of you right now? Is it glass half full, glass half empty?
I think there's two tail risks in the world today. One is a tail risk of recession.
Yeah.
A lot of investors are worried about today. And the other one is a tail risk of persistent inflation and interest rates not paying enough to compensate for that. So debt monetization by governments. So if you think about what's been happening, we see it as a geopolitical stress test. The U.S. has pushed to its limit its allies. It's trying to gather more allies under its banner. It's trying to isolate China and redraft the terms of trade.
Yep.
And you could say that in some ways this stress test has failed. We've gone to the limit of volatility in markets, and potentially we're going to skirt a 0 low digits growth number for a quarter or two. So this has been done, but we don't have a recession. What I'm really worried about is that central banks will have to monetize larger deficits. You've seen the tax proposals. You've seen that even with DOGE, even with potential spending cuts, the U.S. keeps spending. So this is a public debt problem. It's not a problem in corporate balance sheets or household balance sheets.
So basically, the debt has become too big, almost independent of what happens in the growth numbers. This is a buyer and seller story now. It's are there enough buyers? There's clearly a big seller of debt, but are there enough buyers? And your belief now is that ultimately governments are going to have to buy it, central banks are going to have to buy that and step in where others won't.
Diamonds are forever, monetary systems are not. Right? If you look at the history of monetary systems, at some point governments tend to spend too much. Something goes wrong with growth and productivity, and they resort to essentially issuing currency or printing money. And that's essentially what's happening in the West. We see the Fed, the Bank of England, and the ECB, cutting rates and potentially keeping rates well below inflation. So duration and generally government debt is something we don't like. Where are governments spending? If you look at Germany's stimulus, the EU stimulus, they're spending in infrastructure and defense. They're going to support the private sector. So credit is actually not a bad place to be, and it's a better place to be in areas where governments can spend more. So Germany has been very tight on fiscal spending for the last 20 years. Right. They're now open their wallet, and this is going to benefit growth across Europe. Italy got upgraded last week.
Yeah.
Who would have said in this environment? Everyone was worried about issuance, but actually spending is good for growth if you were doing austerity for the last 20 years. So European credit has currently the largest short positioning in the credit default swap market of the last 15 years. Essentially, all-time short positioning by investors and allocators. And typically, investors are very underweight European assets. So if you are worried about debt monetization in countries where there's high inflation, high deficit, you probably want to go in the ones which have been more conservative. So investors we see are, looking for more European assets. And, you want also more real assets. You want things that defend you from this persistent spending. So I'm a lot more worried about risks to the monetary system, what Scott Bessent didn't want to talk about yesterday, which is, the Mar-a-Lago Accord, than 1 quarter of growth at 0.5%. That doesn't worry me. Corporates are in good health. Yep. There's no refinancing wall. They've all termed out their debt, and leverage is very stable, especially in Europe.
Is there a question, though, of too much issuance? I mean, we keep hearing about this when it comes to just how orderly the markets are and that people are able to digest it. But for how long, if the deficits do remain kind of lurking in the background?
The long end of the yield curve is definitely the problem. And you know why we never really had a default cycle in the U.S. when the Fed was hiking 500 basis points? Is the curve was inverted.
Yeah.
So large firms like Google or Apple essentially were able to run a carry trade. They were already funding at long-end rates, and then they were investing in T-bills. And similarly for households, 99% of households has a fixed-rate mortgage in the U.S. So central banks and Treasury officials in the world are definitely worried about the long end, going steeper and wider. But what does that mean? Well, it means that if the long end keeps going higher, there will be countermeasures. And one of them is potentially reducing quantitative tightening. The Bank of England has already paused. Another one could be lowering maturities, and eventually we'll go into a yield curve control environment where essentially currencies will take the hit. Governments today, in a very tense geopolitical environment, cannot afford big spikes in unemployment. And the real risk in my mind is that there's a de facto recalibration of the inflation target by central banks. We've been 48 months above target. Something is transitory until it's not. So, if we keep going above target, and this year we will, then, you're de facto changing your inflation target.
But so lots of things they can do to step that in. But what's the tell on that? If you are talking about yield curve control, if you're talking about the Federal Reserve coming to the rescue, or the Treasury for that matter, Scott Bessent, for example, talking about that, what's the tell? What's the red flag? What's the canary in the coal mine?
I think the sustainability of the dollar as a reserve currency is slowly put under question. And in part, this has been also a geopolitical strategy from China to promote the yuan. But we see also investors, being worried about real returns. So, we see gold at record highs. We see demand for stocks, for credit, for real estate. And, I was in a meeting with central banks a few weeks ago, and the question from the central bank was, why are investors so bullish on everything? My answer was, investors are not bullish on everything. They're bearish on central banks. They're bearish on fiat currencies.
Yeah.
So I'm not too worried about the volatility today.
Yep.
I think that's an opportunity to buy solid assets. But I think investors need to rethink the way they structure their portfolios and the way they think about allocation and correlations. For example, think about a balanced portfolio today or a risk parity strategy today when the safe haven asset is no longer behaving as a safe haven asset.
Alberto, thinking about that then, and you mentioned that the final aim here, you think, is to isolate China. And that geopolitical strategy then is playing out and being acted upon at a time when the United States is, well, should it be more worried about who's going to come and buy its treasuries, to Guy's question. So if you upset China and they don't want to buy so many treasuries, how does this end?
I think that in the near term, this will end into a negotiation. But there are some long-term consequences that will stay. And one of them is probably, investors questioning the amount of trust that they have to put into U.S. assets. So, we used to think that currencies traded in terms of interest rate differentials. They're now trading in terms of trust differentials. I doubt that the U.S. will be able to reconstruct a manufacturing base that is as strong as it used to be 20, 30 years ago, simply because China is now very far ahead in the game. So this line in the sand that the U.S. is trying to trace against China will work as a stabilizer, but will not stop China. And in some cases, if we look at the manufacturing challenge, China has already won.
Yeah. So if the end goal was to isolate China, why upset everybody else along the way?
I think this is a way, if you think about, Athens and the Delian League in Greece, it's a way to sort of force allies to gather together with the United States and tell them, you're either with us or against us. And the execution probably, I think the end game is understandable. The execution probably has been a little bit too volatile and could have been potentially done better, like every other portfolio manager has said, but this is about the middle and lower income class, right? Not about financial markets. But in doing so, obviously there is some damage to the U.S. brand and to the ability of for investors to keep the long end, to keep duration in U.S. assets. So that's something that has reached a little bit a test.
Yeah. What do you own in a world that is trying to monetize debt? What does history teach us about what you want to own? Like, Is it agricultural products? Is it what do I want to own in this kind of environment? If that's where we're heading for, of monetization of these huge debt piles.
So essentially, you have to think about the paradigm of financial markets in a different way. Like the safe haven asset is no longer a safe haven. So you don't want to have something that is a balanced portfolio or a risk parity. It's not something that is based on...
Do I want to own?
What do you want to own is real assets. So you want to own gold. You want to own something that has a link to cash flows that grow with inflation. You want to invest alongside with governments. So, for example, think about Europe. They're doing infrastructure. They're doing defense. And these are sectors where governments in Europe had underinvested for decades. So there's a lot of upside there. You want to own private balance sheets, so corporates and households, so credit instead of governments. Governments are spending to help the private sector. There's a lot of high-yield names in Europe that got government help, from banks, telecoms, to airlines. So you want to own those names that give you between 7 and low teens coupons, instead of owning government debt at 3-4%. So you're getting paid for it.
Yep.
And you want to own assets in more stable jurisdictions that have room to spend and where inflation is still low, so essentially Europe, rather than the US, which is very overweight. One silver lining around the UK obviously lost a bit of ground with Brexit and all that volatility, but there's signs that maybe as a silver lining that, it will get a little bit closer to Europe after the Brexit fallout. Not reversing, but a little bit closer. So I think that there is a lot of upside in Europe, and positioning is completely the other way right now.
All right. Alberto Gallo, CIO and co-founder of Andromeda Capital Management, talking to us a little bit about what you should own in this very volatile environment. Guy was talking about perhaps the Birkin bag being the answer to that question. Really funny that he makes that reference, because as we were speaking to Alberto, we also got headlines crossing that Hermès has surpassed LVMH as the world's most valuable luxury company. This, of course, coming after the massive hit you saw in those earnings as well. LVMH shares down a whopping 8%, Anna. So maybe Guy had the right idea around the Birkins.
Always come to me for handbag
fashion,
advice.
Yes,
and
absolutely.
skincare.
This I know on the 15th of April. Coming up on this programme, big banks in focus then. We recap JP Morgan and Goldman's earnings and look ahead to Bank of America and Citigroup's results later today. We've heard a lot about trading. We've heard a little bit about M&A. We've heard a bit about bank regulation. Will we hear more about the US economy and the consumer? That could be interesting. That's next. This is Bloomberg.
I think there will be advantage to our allies, especially, and a first mover advantage. Usually the first person who makes the deal gets the best deal. So
who do you think will be first?
It's their choice. I think there could be numerous countries that are going to move with all deliberate speed. And again, it's going to be a process. The tariffs are the easiest part. So a country with high tariffs, you can just say, okay, this, get rid of it. It's the non-tariff trade barriers that are more insidious, more difficult to spot. And it's probably going to take a little longer to exercise those demons.
Insidious demons. Interesting language around some of the non-tariff trade barriers. The US clearly doesn't like them. Scott Bessent clearly doesn't like them. Speaking to AMH there, down in Buenos Aires. Let's talk about how the EU is viewing all of this. The EU Trade Commissioner Maros Sefcovic says the bloc is ready for a fair deal with the United States. This after he had a meeting with the Commerce Secretary, Howard Lutnick. Spain also signalling a pivot towards China, which is worth paying attention to. Certainly Washington is. Let's figure this all out and pull it together. Ollie Crook joins us now. Ollie, what have we learned from Sefcovic's trip? How far away could the EU be from a deal? The language before we started to see Trump imposing tariffs was quite hostile towards the European Union.
Yeah, repeatedly, whenever you get a press conference, you sort of get some new insults at the European Union, what it was sort of there designed to do, and whether or not you ever see a Chevrolet on the streets of Munich. That is what we heard from the president yesterday. What we hear from Maros Sefcovic, he's going to brief diplomats today about the 4 hours of discussions he had with Jameson Greer and Howard Lutnick. He put out this tweet yesterday, and I'll just sort of go through this to kind of to take you through what they talked about, that the EU remains constructive and ready for a fair deal, including reciprocity through our 0 for 0 tariff offer on industrial goods, and the work on non-tariff barriers. Now, the zero for zero idea is basically to put a free trade zone between the EU and the United States on industrial goods, zero tariffs for zero tariffs. That isn't so far off of what we had before the new tariff regime from the Trump administration. There's about half of a percentage point on average between the difference in tariffs between the EU and the United States. So the United States is obviously going to want more. That takes us to this concept of exercising these so-called demons of non-tariff barriers, where things get a little bit more complicated. The U.S., for its part, has not yet defined what all of these non-tariff barriers are. If you listen to Peter Navarro, who reiterated this over the weekend, that those could include value-added tax. You talk to any policymakers here in Europe, they say this is basically a sales tax. It is applied indiscriminately to things that we produce in Europe and things that we import. That's basically off the table. I talked to the German finance minister, though, and he said something that where maybe you could have some agreement is getting universal standards on auto manufacturing and regulation, so that basically a car that's produced in the United States could be sold in Europe without any sort of amendments due to sort of regulatory concerns and any differences you'd have in the EU. That being said, Guy, one of the very challenging lines here for the Europeans is basically wanting to give the U.S. concessions on these ideas of non-tariff barriers, while at the same time not basically being legislated on domestic law from the White House.
Yeah, certainly an evolving conversation we'll continue to watch then, Ollie. Tell us a little bit about how Spain is playing this, because I know that we've got Giorgia Meloni going to the United States. You've told us about what Maros Sefcovic has been up to on the trade front. But we also have the Spanish leader heading to China. He's been in China, and he's been in Asia, and he's been talking about closer ties there for some time. What's the latest?
Yeah, and I think as sort of attractive as sort of a narrative this is, the idea that basically the Europeans would move away from the United States and towards China in the face of what has been fairly erratic behavior out of the Trump administration is frankly a fairly negative, limited appetite within Europe. You do have the Spanish that are basically saying they want stronger diplomatic, stronger economic ties with China, but that is something that is not gaining traction really across the European Union. What is interesting, I think, is basically a difference that seems to be emerging within the White House itself, where you have Scott Bessent, who seems to be wanting to get people on side, the allies of the United States, to strike quick trade deals to get that sort of issue resolved so that they can potentially collectively have a trade approach towards China. And for the Europeans, that's kind of pushing against an open door. The Europeans are very alive to the threat that industrial policy in China poses to the EU, so potentially would be open for that sort of thing. That being said, the Treasury is not setting tariff policy. It's Donald Trump. And there are a lot of the people who are on board with Donald Trump's goals in terms of balancing global trade and on China, but basically not endorsing the method, which has basically so far been waging collective tariff war, which would make it potentially a lot harder to get people on side within China. But let's see how this policy develops, because again, the Europeans would potentially be on board to get on board with the United States in terms of a collective approach on China. Remember, before Trump was elected president of the United States, the biggest threat to the European economy, as the Commission saw it, was China.
Well, let's see if that consensus maybe changes or warms as we get closer to that July visit. Bloomberg's Oliver Crook, we thank you so much for giving us that crucial context as we, of course, navigate all the geopolitics that Ollie was laying out there. Plenty of data, plenty of kind of data points to be keeping an eye on, especially in the next 24 hours. At 9 a.m. UK time, in just about 8 minutes, we do get the ECB bank lending survey. About an hour later, the Germany ZEW survey, ZEW, if you're feeling fancy. And then at 1:30 p.m. UK time, the U.S. Empire Manufacturing Survey. So it's basically New York is going to show some of those economic data crunches you're seeing in other parts of the country. 1:30 p.m. UK time, Canadian CPI. But I think the highlight for the markets come back to some of those bank earnings. Citigroup, Bank of America, a little bit of United.
United Airlines out. Scott Kirby's going to be out with his numbers a little bit later on. Does he do an Ed Bastian and effectively withdraw guidance? He has a much bigger exposure globally. Be interesting to see what he has to say a little bit later on. But the banks certainly are a big focus later as well. Bank of America, Citigroup's earnings come after Goldman Sachs stock traders posted their highest quarterly revenue haul on record yesterday. This was David Solomon speaking on the earnings call, and there's a certain amount of optimism about trade policy coming from Mr. Solomon.
This uncertainty around the path forward and fears over the potentially escalating effects of a trade war have created material risks for the U.S. and global economy. We are encouraged by the administration's recent actions to pursue a more gradual policy process that allows for considered negotiations with many countries. But how policies will evolve is still unknown.
David Solomon. A lot of optimism coming through from him. Charlie Wells is sitting next to me to carry on the conversation. He sounded pretty positive on the economy, but he also he listed a whole lot of things that he kind of hopes are going to happen.
Yeah, Guy, you know what? He also didn't list at all the word tariff.
Yeah.
That was not mentioned on the call
Like deregulation, all that kind of stuff.
Yes.
That's all coming.
Kind of trying to return to that kind of November talking point playbook of, yes, you know, we're going to get all the candy and none of the vegetables.
November was lovely.
Exactly. We're going to have the deregulation on the capital front, on the leverage front, on the supervisory front. So really trying to seem to sort of shift the narrative and take it to the extreme. But you know what? They had a good quarter, right?
Yeah.
Their equities trading did quite well there. It seemed like he was hoping that administration officials were listening to that call, kind of saying, we hope that those who are making policy will listen to businesses large and small.
So where does that leave us then in terms of the bank earnings story? Because we've heard from Goldman, we've heard from a few of them. How are analysts expecting that Citi and Bank of America will fare? The story up to this point has been around trading, or the strength certainly has been around trading in equities.
Right, so we're kind of rounding out big bank earnings season. And I think something interesting is, you know, how are these two banks going to navigate this trade war? And how are they going to communicate? Are they going to follow the strategy that all these executives have been following, which has been, you know, admit to some of the difficulties, but really focus on the positives? And I think, you know, there are some difficulties for these two final banks, right? Citi is really interesting because so much of their net revenue comes from abroad. I think it's about 50%, which is pretty striking there, bigger than the rest of the big banks in the U.S. Also credit cards, right? So they have a high proportion of their loans coming from credit cards. If we get to a downturn situation, that could be bad because we know loans for credit cards are very volatile in downturns. Thinking of Bank of America later today, net interest income. That's something we haven't been hearing too much about this earnings season, but that could be under pressure if we get to this rate environment.
You're speaking Kriti's language here. She's been deeply interested in the fate of credit cards and autos loans.
Well, in autos loans, this is true, but in the FX piece, right? You mentioned that the majority of Citi's revenue comes from abroad. This is why you can have international credit cards with Citi that you can't, or it's harder to have with some of the other banks as well. So the FX cost, especially with the dollar weakness, is going to be a really crucial one as well. Very quickly, Brian Moynihan, has he said anything? He was kind of the consumer bull.
He has been the consumer bull, and Bank of America has a lot of consumer exposure, right, across mortgages, of course, across credit cards as well. He's going to want to dance very delicately today because remember earlier this year, he was called out point blank at a very public event. So I think he's going to have to kind of really kind of thread the needle carefully there.
Especially as we kind of see Jamie Dimon and David Solomon with the same message, doing a little bit of a U-turn. Bloomberg's Charlie Wells walking us through those bank stories. Of course, he'll be back later throughout the week giving us those updates as well. Later today, we are going to speak with a Hyundai CEO on how South Korea's largest automaker will try and navigate Donald Trump's tariffs. That conversation coming in at 3:30 p.m. UK time as the Trump administration remains very optimistic around trade deals with Japan and South Korea. In the meantime, a mixed picture for stocks. That does it for the opening trade. The Pulse is up next. This is Bloomberg.